insurance has got some principles that are applied when claims are being made and when claims are being paid out. And learners, you've got to know the 4 concepts or the 4 principles, and it's called the average clause, indemnity.
Then we have insurable interest and the principle of utmost good faith.
Okay, so let's start with the average clause. Melanie, what does that entail?
So when we're talking about the average clause, it simply means that there will be a payment of the insurance claim according to the amount of the insured. It is applicable when the insured has underinsured the asset and the asset was not insured at its full value.
Okay, then they employ the average clause principle. Okay, and we're going to come to a calculation later on based on the average clause principle.
Okay.
Melanie, we've had a question here from Lutando, and the question is, what happens if the business overinsure? I think we've clarified it, but don't you just want to go over that again? When a business overinsures, what happens?
Leicester, when a business overinsures, they pay a higher premium, first of all, because the intention is not for them to make a profit. So they will pay the higher premium, and
also they insure the building or the asset
for more than what it is actually worth.
The market value.
Yes.
Okay, great stuff. Okay, that was the average clause. Now, can we just use an example here for the average clause? And I think you alluded to it earlier.
Yes.
But maybe we can just clarify it. And this could be the house that you bought recently for 10 million. So now the asset, or it could be anything, but let's assume it's a house being bought for 10 million. But it's only insured for 8 million. And so you can already see we've got underinsurance of 2 million.
That's correct.
Okay. But initially, that's not a problem. The problem only arises when there's a claim. For example, there's a fire.
Or any kind of damage that occurs.
Or any kind of damage that occurs. And so, remember you bought it for 10 million?
And you insured it for 8?
You insured it for 8. And the damage of that fire is 4 million.
Estimated at 4 million.
So the $1 million question now is, how much money will the insurance company pay the homeowner? Now remember, his damage is 4 million.
Yes.
Is he going to get the 4 million? What the insurance will do is, they will apply the average clause principle. And so in order to apply that principle, Melanie, there is a formula that they use. Now, if you want to do this calculation correct, you must know this formula. They're not going to give it to you. By the way, if you do write it down, you might even get 2 marks for it. And so what does this formula state? It says quite clearly, the insured amount you take and you divide it by the market value of the asset, and then you multiply it with the value of the damage.
So let's plug in the numbers for them quickly, Leicester.
Okay.
So the insured value.
Okay. So let's just go through it quickly.
Okay.
The insured value, Mel, is.
Would be?
So we are substituting now.
Yes.
So once you've got your formula, we can substitute the information that you have available.
That's correct.
Okay. So Melanie, what do you say?
So the insured value is 8 million.
The insured value is 8 million. So we're going to write 8 million there.
And then we bought the property at market value for 10 million.
And so we're going to write
10 million would go there.
And then multiply?
Multiplied by the damage incurred by the fire, which was 4 million.
4 million. Okay, so let's see quickly what happens if we do that. Okay, so here's your 8 million. There's your 10 million.
Divided by your 10 million.
Times your 4 million, which was the damage.
That's correct.
And so ultimately, the insurance company is only going to pay out 3.2 million.
Correct.
Remember, your damage was 4 million, eh? But because you're underinsured, the insurance company is not going to pay you the full value of your damage. What is the moral of the story? Don't underinsure. And how do you make sure that you don't underinsure? Make sure that you have the value of your assets evaluated annually. And take into consideration also the inflation rate.
And it's also important for companies to do that annually because it then goes into the projected cash flow statement for the following year.
For the following year. And Mel, we had an answer here from Ilam.
Yes.
Ilam said,
What does Ilam say?
okay, it's 3.2 million.
Oh,
Ilam, you must just please indicate which school you're from. I see there are quite a few learners from, I think it's Atlanta Secondary, Peakview Secondary, I think Rosendal is also tuned in, Rangeville. Now, earlier I greeted the learners and teachers from the Western Cape, but Rangeville is in Kuruman.
Yes.
So that's Northern Cape. And so we want to welcome learners and teachers from the Northern Cape also. Now, I think that went well. Let's see the next principle.
Okay, so the next principle is that it's to indemnify. And this is where the insurance company will put the insured in the same financial position as before the event took place. So the whole idea here is that the insured will be covered for the loss or the risk or the damage.
Yeah, great. Now we just got a message here from one of the students who are asking us to keep the slides a little bit longer because they would want to write down the information. Now learners, we covered this in the previous session where we indicated that we've got a limited amount of time available. So you're going to battle if you're going to try and write down everything that we do display on the screen. However, if you want a copy of this PowerPoint, I indicated earlier what my email address is, so I'm going to give it to you again at the end of the session. Send me an email, and I will gladly forward you a copy of this PowerPoint presentation.
Leicester, don't you think we should just put the link up to the e-portal again?
The link for the e-portal?
Because the the presentation will be uploaded soon,
yeah.
So they can also then go and get it off there.
Yeah, right stuff. Thank you for reminding me of that, Melanie. If I can just get hold of it. Somehow or another it just disappeared. Okay, here it is. If we can just get the overhead shot. I indicated that this video will be on the Western Cape e-portal site. So you'll have the whole video session, not just this one, but the previous 3 sessions also. And there's much more than just this.
And the link for the PowerPoint upload as well?
That will also be on the portal.
Okay, perfect.
If not, it will be on the Business Studies website, but you can get that information also from the portal.
Great. Okay, so we were speaking about indemnify, and this is again the case of if I had a Samsung phone, a specific Samsung phone, something happens to it, I dropped it by accident and my insurance put in a claim at my insurance, they will replace it with exactly the same Samsung phone.
Okay, so here you can see an example. This was the original one.
Yes.
You got for a present, Mother's Day. This looks like the Samsung S1 Mini. Mm-hmm. And then the next day, it was dropped, stolen. And now you try and put in a claim for a Galaxy S7 Edge.
Yeah.
Is it going to happen?
No.
No, it's not going to happen.
There we go.
If they indemnify you, they will put you in the same position.
Yes.
And you get the same one. There's one learner indicating that, can I get a copy of the info on the slides through WhatsApp? We will have to explore that, but we'll keep that in mind. I'm being taught quite a few things today.
Okay.
Now, insurable interest. Insurable interest. What is that?
Lisa, I'm leaving this one up to you.
Okay, what does it say? A person can only insure an asset and claim if they are going to suffer a financial loss when an event occurs. Insurable interest simply means that you can insure an asset and claim if you are going to suffer a loss when it occurs. Now, if you look at examples of insurable interest, an individual can insure his or her own life. Okay, so what's going to happen? I've got a family, so I can insure my life. So if I die, hopefully it's not going to happen soon, but if I die, my dependents will then get a lump sum payout.
That's correct.
Okay, so an individual, any person, provided you've got the money to pay your premium, you can insure your own life. So that's a general rule. An individual or a business may insure not only his life, but also his assets.
Yeah.
So if you've got a house, a car, a cell phone, you can insure not only your life, but also your assets. It must belong to you. I think that's important.
Yes.
A married woman can insure the life of her husband.
And also vice versa. The husband or a husband can insure the life of his wife.
Okay, so that's also true. Okay, thank you. A business partner
Can do the same.
can insure the life of the other business partner. Now that makes sense because if he dies, then you sit with all the liabilities.
Yes.
So please, if you're in partnership with anybody, make sure that their lives are insured.
That is correct.
And then finally, a creditor, remember a creditor is a person to whom money is owed, can insure the life of the debtor, the person owing him the money. If he doesn't do that, and that debtor dies, his money also dies with the debtor. So it's important that if you do lend people money, make sure that you insure their lives also. And that we call an insurable interest. You've got an insurable interest in those people's lives. Okay, the next one, Mel, is utmost good faith. Not just good faith, but utmost. What does that mean?
It's basically a trust relationship between the insurer and the insured, and it expects of the insured to be absolutely honest when taking out this particular contract. So, for example, learners, if Leicester decides his favorite sport is rock climbing,
Heaven forbids.
when he does take out this particular insurance, he is then under obligation to disclose to the insurer that he participates in dangerous sports.
Yeah, good.
And that would be the same for anybody who's very adventurous.
Yeah.
But in that way, there's a trust relationship between the insured and the insurer, and that there is full disclosure.
And also if you've got a pre-existing medical condition,
Yes.
that you do acknowledge that and make it known.
So you would do it for those kinds of situations. It's mostly done when you get to sporting activities that are fairly dangerous, medical conditions, and possibly even if you have a car that you've had for a very long time and has accumulated quite a substantial mileage in excess of maybe 650,000 kilometers. So once you start, negotiating that insurance contract, you would then disclose that.
But now that utmost good faith is also on the part of the insurer.
True.
So
True.
if you pay your premiums regularly, there's that good faith or utmost good faith that in the event of a legitimate claim, that they will pay you out and not just claim they are bankrupt.
True.
So
True.